Nobody rings a bell before a crisis starts. There's no announcement, no warning label, no responsible adult standing at the edge of the cliff telling you not to walk toward it. In 1929, people thought the party would last forever, right up until the Tuesday morning it didn't. In 2008, the housing market looked solid to most people who were watching it, even the people inside it. And in 2020, a virus no one had named yet was already quietly dismantling supply chains before a single government had issued a single warning. Every time, the story starts the same way. Not with a dramatic collapse, with something that looks completely fine. So here's the uncomfortable question no one in finance wants to sit with for too long. What if the next crisis has already started, and it's just not in the place we're trained to look? The pattern no one wants to talk about. There's a very human tendency to prepare for the last war. After 2008, regulators built entire frameworks around mortgage-backed securities, subprime exposure, and bank leverage ratios. After the dot-com bubble, people swore off loss-making tech companies with no revenue. After every crash, the lesson gets applied to the previous disaster, while the next one is already forming somewhere else entirely. This isn't stupidity. It's pattern recognition misfiring. The brain looks for what hurt it before and avoids that specific shape. But crises rarely repeat their exact shape. They borrow the same logic: too much leverage, too much faith, too little scrutiny, and wear an entirely different face. So where does that logic live right now? Where is the faith strongest? Where is the scrutiny weakest? That's where you look. And right now, 3 places stand out. Not because they are certain to collapse, but because each one contains the same quiet ingredients that have preceded every major economic disruption in modern history. Corporate debt, the slow leak in the system. Start with something that doesn't make headlines, because it moves slowly. Over the past 15 years, corporations around the world, particularly in the United States, have borrowed at a scale that would have seemed almost reckless to any previous generation of business leaders. But it didn't feel reckless, because money was cheap. Interest rates were kept near zero for so long that debt stopped feeling like debt and started feeling like fuel. You borrowed to buy back your own stock. You borrowed to acquire competitors. You borrowed to pay dividends. You borrowed to borrow better. The result is that corporate debt in the US alone crossed the $13 trillion mark. Global non-financial corporate debt is in excess of $90 trillion. Those numbers are large enough to be meaningless until you understand the mechanism that turns them dangerous. It's not the borrowing, it's the refinancing. Most corporate debt isn't a 30-year mortgage. It rolls over, it matures, and when it matures, companies have to go back to the market and borrow again, at whatever rate exists at that moment. For companies that loaded up during the era of near-zero rates, that moment is arriving. Trillions of dollars in corporate debt will need to be refinanced over the next several years at interest rates that are meaningfully higher than when the original loans were made. For healthy, cash-generating businesses, this is uncomfortable but manageable. For the ones that stretched, the ones that were already carrying more debt than their earnings could comfortably service, this is where the math stops working quietly and starts causing problems loudly. There's a category of corporate debt called leveraged loans. These are loans made to companies with already elevated debt levels. The market for this kind of lending has expanded dramatically, and a significant portion of it has been packaged and sold to institutional investors in structures that, if you look at them long enough, start to feel uncomfortably familiar to anyone who remembers what happened with mortgage-backed securities before 2008. Same logic, different wrapper. The concern isn't that every leveraged borrower defaults. Most won't. The concern is what happens when enough of them struggle at the same time, when the refinancing stress converges with an economic slowdown, when investors who bought the packaged debt start marking it down, when credit tightens just as the companies that need it most can least afford it. That sequence is not inevitable, but the ingredients for it are already in place. Commercial real estate, the empty building in the room. If corporate debt is a slow leak, commercial real estate is a building that's been noticeably emptying out for 4 years, while everyone politely pretends not to notice. The pandemic changed where people work. That much is obvious. What's less discussed is what that change actually means for the balance sheets of banks, pension funds, and insurance companies that hold significant exposure to commercial property loans. Office vacancy rates in major U.S. cities have climbed to levels not seen in decades. Some buildings that were fully leased before 2020 are operating at a fraction of their prior occupancy. The math on these properties has fundamentally shifted. The income they generate relative to the debt they carry has deteriorated in some cases severely. Now here's the part that matters for the broader economy. This isn't just a real estate problem, it's a banking problem. Smaller and mid-sized banks, the ones that don't make the front page of financial news on normal days, have outsized exposure to commercial real estate loans relative to their total assets. When those loans were performing, when tenants were paying rent and property values were rising, the exposure looked fine. When vacancies rise, when property values decline, when borrowers can't refinance, that exposure starts to look very different. We've already seen tremors. The regional banking stress in early 2023 wasn't primarily about commercial real estate, but it illuminated how quickly confidence in smaller institutions can shift. The commercial real estate correction hasn't fully played out yet. Property transactions have slowed dramatically, which means price discovery has been sluggish. Many assets haven't been forced to reveal what they'd actually sell for in a distressed scenario. When that discovery happens, and at some point it will, the losses have to land somewhere. The question is how concentrated they are and whether the institutions holding them are strong enough to absorb them without triggering a broader pullback in lending. A broad pullback in lending is how a property problem becomes an economic problem. When banks tighten, small businesses can't borrow. When small businesses can't borrow, they contract. When they contract, employment softens. That's the transmission mechanism. That's how a real estate stress in an office tower in Chicago eventually shows up in the unemployment figures. The sovereign debt question. What happens when governments can't afford themselves? The third ingredient is the one that feels most abstract until it doesn't. Governments around the world have been spending at levels that would have been considered extraordinary by any historical standard, for reasons that have often been legitimate: financial crises, pandemics, wars, infrastructure gaps, aging populations demanding services. The spending happened, the debt accumulated, and for a long time, the cost of carrying that debt stayed manageable because interest rates were held so low. That era is over. The United States now spends more on interest payments for its national debt than it does on national defense. That sentence is worth sitting with for a moment. The richest country in the history of the world is directing more of its annual budget toward servicing past borrowing than toward any single discretionary priority. This isn't a uniquely American situation. Japan's debt-to-GDP ratio is the highest in the developed world. Several European countries carry debt levels that require perpetually low borrowing costs to remain manageable. Emerging market nations that borrowed in dollars during the low-rate era are now servicing those debts with currencies that have weakened significantly against the dollar. None of this means an immediate crisis. Governments can carry high debt for a long time when investors continue to buy their bonds. The risk is in the feedback loop. When debt levels rise, borrowing costs. When borrowing costs rise, more of the budget goes to interest. When more of the budget goes to interest, less is available for everything else. For stabilizers, for stimulus, for the tools governments typically use to cushion an economic downturn. And if a downturn arrives when fiscal space is already constrained, the response options are fewer, and the pain is deeper. The concern isn't that any specific government can't pay its bills tomorrow. It's that the buffer between stability and stress has thinned considerably. Governments that once had room to absorb economic shocks through aggressive spending now have to make harder choices about how much more debt they can absorb before the market starts asking questions they don't want to answer. Markets, when they start asking those questions, tend to ask them very quickly and all at once. The invisible connective tissue. What makes these three things worth considering together isn't that any one of them is certain to cause a crisis. It's that they're connected. Corporate stress tightens credit. Tighter credit hits the businesses that have been keeping commercial property partially occupied. Property losses hit regional banks. Regional bank stress affects small business lending. Small business contraction weakens tax revenues. Weakened revenues strain government budgets, already under pressure from rising debt costs. Government austerity under stress weakens demand. Weakened demand makes corporate earnings harder to achieve, which makes debt service harder to manage. Round and round. This isn't a prediction. Cycles don't follow scripts. But the architecture of the current moment, the way these pressures are positioned relative to each other, creates the kind of environment where a moderately bad event in one place can become a severely bad event everywhere else. That's how crises actually work, not one dramatic failure, a chain of smaller ones, each weakening the next link's ability to hold. The counter-argument, and why it matters. It would be intellectually dishonest not to acknowledge what the other side of this argument looks like. Financial systems are more regulated than they were in 2008. Bank capital requirements are higher. Stress testing is real. The mechanisms for government intervention, while constrained, are more sophisticated than they were in the 1930s. Global central banks have demonstrated a willingness to act aggressively when stability is threatened. Labor markets have remained surprisingly resilient. Consumer balance sheets, at least in aggregate, are in better shape than they were prior to previous downturns. Technology continues to generate genuine productivity gains that justify portions of what might otherwise look like irrational optimism. There is a real possibility that the pressures described here are absorbed gradually, that the refinancing stress is managed, that commercial real estate losses are contained, that fiscal adjustments happen without panic. History doesn't guarantee disaster. It only shows that the conditions for disaster aren't rare, they're structural, and they recur. The question isn't whether to panic. The question is whether to pay attention. Every major economic crisis in modern history has one thing in common after the fact. The signals were there. Not necessarily obvious signals, not necessarily signals that any individual person could have acted on in a simple way, but signals that once the crisis arrived, looked so clear in retrospect that people genuinely asked how anyone could have missed them. The reason they were missed isn't ignorance. It's that when systems are working, there's enormous social and financial pressure not to question them. The people who were loudest about mortgage risk in 2006 were dismissed as alarmists. The people who pointed to Enron's balance sheet were told they didn't understand the business model. Doubt, when it goes against the prevailing mood, is uncomfortable to hold and expensive to act on, which is precisely why it matters. The next crisis won't start with a headline. It'll start with a number that looks manageable until it doesn't. A vacancy rate, a refinancing rate, a bond auction that goes slightly worse than expected. Small, specific, technical. The kind of detail that only seems important once you know what came next. The question worth sitting with isn't whether a crisis is coming. It's whether you've looked past the obvious places long enough to see what's forming in the ones that nobody's watching yet. Because that's always where they start.